Contracts are the foundation of business and personal agreements. They outline the rights and responsibilities of each party, ensuring clarity and legal protection. In this video, we'll explore the most common types of contracts you might encounter, from employment agreements to sales contracts. Understanding these basics can help you navigate both professional and everyday situations with confidence. Let's start by defining what a contract is and why it's so important in our daily life. Contract is a legally binding agreement between two or more parties. It can be written, oral, or even implied by conduct. The key elements of a contract include an offer, acceptance, consideration, and mutual intent to be bound. Without these elements, an agreement may not be enforceable in court. Contracts are used in countless scenarios, from buying a house to hiring a new employee. Now, let's look at the different types of contracts you're likely to encounter. Express contracts are agreements where the terms are clearly stated, either in writing or verbally. Both parties explicitly agree to the terms, leaving little room for misunderstanding. For example, a written employment contract or a verbal agreement to purchase a car are both express contracts. These contracts are straightforward and easy to enforce because the obligations of each party are clearly outlined. Implied contracts are not explicitly stated but are inferred from the actions or circumstances of the parties involved. For instance, when you visit a doctor, it's implied that you'll pay for the services provided even if there's no written agreement. These contracts are just as binding as express contracts, though proving their existence can sometimes be more challenging. Bilateral contracts are the most common type of contract. In these agreements, both parties make promises to each other. For example, in a sales contract, one party promises to deliver goods and the other promises to pay for them. Most business and personal contracts are bilateral as they involve mutual obligations. In a unilateral contract, only one party makes a promise and the other party accepts by performing a specific act. A common example is a reward contract. If you offer a reward for finding your lost pet, you're only obligated to pay if someone finds and returns your pet. These contracts are less common but still important in certain situations. Executed contract is one where both parties have fulfilled their obligations. For example, after you buy a coffee and pay for it, the contract is executed. These contracts are complete and no further action is required from either party. Understanding when a contract is executed helps avoid confusion about ongoing responsibilities. Executory contracts are those in which some or all obligations have yet to be performed. For instance, if you sign a lease for an apartment, the contract remains executory until the lease term ends and all rent is paid. These contracts are ongoing and require continued performance from one or both parties. A void contract is one that is not legally enforceable from the beginning. This could be because the subject matter is illegal or one party lacked the capacity to contract. For example, a contract for an illegal activity is void. Such contracts have no legal effect and cannot be enforced by either party. Voidable contracts are valid and enforceable, but one party has the option to void the contract due to certain legal defenses. For example, if a contract was signed under duress or by a minor, the affected party can choose to enforce or cancel it. These contracts provide flexibility and protection for parties who may have been unfairly pressured. An unenforceable contract is one that cannot be enforced by law even though it may appear valid. This can happen if the contract lacks a required element, such as being in writing when the law requires it. For example, some real estate contracts must be in writing to be enforceable. Without this, the contract is unenforceable. Adhesion contracts are standardized agreements drafted by one party, usually with much stronger bargaining power and offered on a take-it-or-leave-it basis. Think of software license agreements or insurance policies. The other party has little or no ability to negotiate the terms. These contracts are common in consumer transactions. Unconscionable contracts are agreements so one-sided that they shock the conscience. Courts may refuse to enforce these contracts because they are unfair or oppressive. For example, a contract with extremely high interest rates or hidden fees might be considered unconscionable. These contracts highlight the importance of fairness in agreements. An option contract gives one party the right but not the obligation to do something in the future, such as buying property. The other party is bound to keep the offer open for a specified period. These contracts are common in real estate and financial markets, providing flexibility and time for decision-making. Sales contracts are agreements for the purchase and sale of goods or services. They specify the terms of the transaction, including price, delivery, and payment. These contracts are essential in both business and consumer transactions, ensuring that both parties understand their rights and obligations. Employment contracts outline the terms of employment between an employer and employee. They cover salary, job responsibilities, benefits, and termination conditions. These contracts protect both parties by setting clear expectations and reducing the risk of disputes in the workplace. Lease contracts are agreements to rent property, such as an apartment or office space. They specify the duration, rent amount, and responsibilities of both landlord and tenant. Lease contracts help ensure that both parties understand their rights and obligations during the rental period. Service contracts outline the terms for providing services such as repairs or consulting. They detail the scope of work, payment terms, and deadlines. These contracts are crucial for managing expectations and ensuring that both parties are clear about their responsibilities. Partnership agreements are contracts between business partners. They outline each partner's contributions, profit sharing, and management roles. These agreements help prevent misunderstandings and provide a framework for resolving disputes, making them essential for successful business partnerships. Non-disclosure agreements, or NDAs, are contracts that protect confidential information. They prevent parties from sharing sensitive business details with others. NDAs are common in business deals, employment, and partnerships, helping to safeguard trade secrets and proprietary information. Franchise agreements allow one party to operate a business using another's brand and business model. These contracts set out the terms for fees, support, and operational guidelines. Franchise agreements are key to maintaining brand consistency and ensuring both parties benefit from the arrangement. Loan agreements are contracts where one party lends money to another with terms for repayment, interest, and collateral. These contracts protect both the lender and borrower by clearly outlining the repayment schedule and consequences for default. Construction contracts are agreements for building projects. They specify the scope of work, timelines, costs, and quality standards. These contracts help ensure that construction projects run smoothly and that all parties understand their roles and responsibilities. Insurance contracts are agreements where one party pays premiums in exchange for financial protection against specific risks. These contracts detail the coverage, exclusions, and claim procedures. Insurance contracts provide peace of mind by ensuring compensation in case of loss or damage. Licensing agreements allow one party to use another's intellectual property, such as trademarks or patents, under specific terms. These contracts outline the scope of use, royalties, and duration. Licensing agreements are common in technology, entertainment, and branding. Consulting agreements are contracts for professional advice or services. They specify the consultant's duties, payment, and confidentiality requirements. These agreements help ensure that both the consultant and client understand the scope and expectations of the engagement. Joint venture agreements are contracts between two or more parties to undertake a specific business project together. They outline each party's contributions, profit sharing, and management structure. These agreements are essential for successful collaboration and risk management. Settlement agreements resolve disputes between parties without going to court. They outline the terms for resolving the issue, such as payment or other actions. These contracts help save time and money by avoiding lengthy legal battles. Purchase order is a type of contract used in business transactions. It's a buyer's written offer to purchase goods or services, specifying the details of the order. When accepted by the seller, it becomes a binding contract. Purchase orders help streamline procurement and ensure clarity in business dealings. Understanding the common types of contracts is essential for both personal and professional success. Contracts provide structure, clarity, and legal protection in a wide range of situations. Whether you're entering a simple sales agreement or a complex business partnership, knowing the basics of contracts can help you make informed decisions and avoid potential pitfalls. Always read and understand any contract before signing, and seek legal advice if you're unsure. With this knowledge, you're better equipped to handle agreements with confidence.